Welcome to the Stockout. I'm Mike Bowden-Distel. I'm the head of Intermodal Solutions here at FreightWaves, and the Stockout is your show about all things related to the consumer packaged goods (CPG) industry and their supply chains. And today I'm going to be talking through a couple of companies that reported earnings last week. A couple of the very largest players reported earnings. We had Nestle, we had Procter & Gamble. Also talk about why we at FreightWaves do not think there's going to be much of any peak season in terms of freight transportation. That's been a big theme last week from a lot of the carriers reporting earnings, and also been a big theme for, really a number of months in the data that we're seeing at FreightWaves. And then on this show, I'll also be talking to Kevin Williamson. He's the CEO of RJW Logistics Group. This is a company that helps CPG companies lower their transportation costs by consolidating LTL into truckload. So be talking to him. But first, a word from today's sponsor, which is RJW Logistics Group. RJW owns and operates every step of the middle mile. As an asset-based integrated logistics company, they offer a full suite of retail supply chain solutions under one roof, including industry-leading retail consolidation that consistently delivers over 98% on time and in full, month after month to many retailers. RJW's programs offer global suppliers control and transparency, helping them improve in-stocks, achieve retailer compliance, grow market share, and increase sales. Visit rjwgroup.com to optimize your supply chain today. So big thanks to RJW Logistics Group. Has been a big deal is achieving those in-stocks and avoiding those retailer fees. So with that, I'll go into the first topic, which is Nestle's results. I really thought showed a lot of resilience last week when they reported. It's a stock chart for the Nestle ADR. So it's a Swiss company. If you wanted to invest in it as a U.S. investor, this would be the easiest way to do it. You can see it's kind of back. This is a 5-year chart, so it's kind of back to pre-pandemic levels. Still a decent return over 5 years. And, really sort of the key takeaway for me for Nestle is that they're really seeing a limited demand elasticity so far. So if you just look at their North American segment, which I think is going to be the segment that's most applicable to those people that are watching this show, is their pricing was up 11.1% in the quarter, and their volume was basically flat, up 0.1%. So really, I think most businesses would take that 11% price increase, not seeing any demand degradation. They did say they are seeing some elasticity in certain foods and dairy, but they say it's sort of been really limited in light of the pricing actions that they've taken. Dairy has been one of the most inflationary components, categories of food. They're saying worldwide sales growth 8.5%, lower than the 8 to 9% that they were seeing, and 9% year to date. So they've maybe seen just a little bit of slowing in their sales relative to what they saw earlier in the year, but really doesn't seem to be too big of a deal. Like most CPGs, they're still trying to get caught up on margins, and would say that virtually all CPGs have lower gross margin and operating margins that they had before the pandemic. They say that's going to the catch up on gross margins is going to take them into 2023. Not a surprise there. They maybe one thing that was a surprise, they acquired Seattle's Best from Starbucks, so that's going to bolster out their coffee offerings. They've gotten to be the biggest, I guess the second biggest player in packaged coffee after JM Smucker Company, really sort of addressing the higher end brands, things like the Nespresso, and they did that big deal with Starbucks. A few years ago, seems to be doing well with that. The Seattle's Best gets them into that mid range, category. Got some detail from Nestle on their analyst call in terms of what sort of strategies they're taking in terms of supply chain management. And one of the big ones is reducing the number of SKUs, which we've seen from a lot of other CPG companies. And Nestle calls this cutting the tail to push the head, which is kind of a silly slogan, but I think a good strategy. They're so big in a lot of these food products that they say, well, if they eliminate the lower performing SKUs, their customers are just going to go right to their better performing SKUs. That's going to lead to improved, efficiency. And I think that's a solid strategy. They do tend to, have a strategy that is in the higher, tier of product categories. As I said a few years ago, they about 11% of their product portfolio was in what they would call premium brands. Now it's 35%, which really positions them well to handle this type of marketplace where some consumers are cutting back, going to private label. It's really not as big of an impact on the higher income consumers, and then there are a lot of products that just tend to be more stable, either because they taste a certain way or because they're more habit forming, like coffee. They did have an interesting comment on their own prices versus private label brands, and they say that the spread there between their price and private label has narrowed a little bit, and they attribute that to so much of the price increase in packaged food coming from ingredients. Ingredients make up a larger portion of the costs for private label, and so they've had private labels have to increase more on a percent basis, and so those prices have narrowed a little bit. Nestle also talked about how they increased their prices maybe a little bit earlier than the competition increased their prices, and that seems to go into the broader strategy of selling into the retailers. When the ingredient prices start to finally crack, a lot in the industry think that that's when the retailers will no longer accept price increases from the CPGs, that they're doing more to audit what the CPGs should really have to increase their prices in order to preserve margins. And so Nestle's taking the approach that they increase their prices a little bit before some of their competitors do. That seems to be a smart strategy. Also, and maybe it's a little bit less noticeable now with other CPGs still raising their prices. Although I think we're getting a little bit close to a period where those prices level out at a relatively high level. So most things going well at Nestle. I'll move on to the other next topic here is Procter & Gamble. Show consumers are trading down a bit in personal care products in consumer staples. I have a Procter & Gamble price chart, which this was a stock that really performed tremendously well from let's call it the beginning of 2018 up through towards the beginning of the pandemic, went from $70 a share to $130 a share. Really outperformed its competitor Unilever. It's been a little bit choppy since then, but still shares are above pre-pandemic levels, and was really one of the companies that earlier in the year when we had the big stock market sell-off, one of the names that benefited from that flight to quality to go into something that is going to be more stable. And the company in the third quarter is able to beat estimates for earnings and revenue. They did say volume declined the past 2 quarters, and it seems like maybe the biggest culprit for this is the foreign exchange, where that is end up being a bigger drag than they previously believed with the stronger dollar. So they have to translate those foreign sales back into dollars. Like Nestle, seeing a gross margin contraction. They said gross margin declined 160 basis points or 130 basis points on a currency neutral basis. Operating margins still down 70 basis points versus a year ago. So that's true of most CPGs. It does take time to catch up. The costs rise faster than a lot of those the CPG companies will push the pricing through the retail channel and onto consumers. Would say that the thing that stood out to me with Procter & Gamble, volume declined 3% year over year. That's actually kind of a big decline for something that is such a staple. Most of the product categories are. There are options to trade down to lower brands in a lot of those categories, but you consider pricing, increased 9%. It's kind of a 1 to 3, elasticity, ratio, volume to price. So still not terrible, and I think the company will take that. They did, have a guidance now for sales growth of negative 3% to 1%. That includes a 6-point negative impact for foreign exchange. So that's, I think, going to be a theme as more of these multinationals that report in U.S. dollars report earnings is this headwind from foreign exchange. Doesn't impact Nestle. There is a Swiss company can actually be a benefit to them. With that, I'll just touch briefly on this article that came across a day or two ago from Winsight Grocery Business. They said that there's going to be a shrinking, they're seeing a shrinking basket size when consumers go to the grocery store. They said that the number of consumers that are purchasing fewer items went from 15% a year ago now to 24% last month. And maybe what's surprising is they're seeing that across income levels, including those making over $100,000 a year, are buying fewer items. There's sort of groceries being lumped into two categories that are doing well. Some of those are big package sizes where you get a smaller a cost per unit. And then the other ones are just smaller package sizes, which is just a smaller overall cost that would apply more to the consumers that are cash strapped. So the package sizes that are kind of in the middle getting kind of squeezed out here. I'll touch briefly on an article that just came across that Craig Fuller, our CEO, wrote for freight companies. This peak will be weak. He has a rhyme in there. I'd say go ahead and read that article. I'm not going to go through it because we're a little bit time strapped, and I can't say those things as well as he did. But for me, the biggest quote last week from the carriers that reported earnings was J.B. Hunt, which said that the peak season this year will not be much of an event. And they're the biggest domestic intermodal company, very big in other sectors of domestic transportation as well, truckload, dedicated and brokerage. But, intermodal does tend to have, such a peak season in, October and November. They're not seeing that, this year. I'd say go read that article. Also check out the newsletter that I sent out went out Sunday morning, went through some of the data, the data highlights. So that's a little bit of an overview of the news. Go read that article. And I just want to give a little bit, another shout out to RJW for sponsoring this show. Are you assessing the advantages of prepaid versus collect freight management for delivery into retail? RJW's retail consolidation program consistently delivers over 98% on time and in full to ensure a stronger shelf presence, increased in-stocks, retailer compliance, and overall retail supply chain improvement. Visit rjwgroup.com to speak with a retail logistics expert about the advantages of RJW's program and to make the best decisions for your business. So thanks to RJW, and would like to bring on today's guest, Kevin Williamson. He's the CEO of RJW Logistics Group. Kevin, thank you for joining me. Good to see you again. Thanks for sponsoring the show again.
Absolutely. Glad to sponsor CPG companies and your show. A lot of interesting information that you continue to share with the group. So
great. Well, appreciate that. So our RJW Group, I would ask the production team to put up the chart with the trucks, because that's the one to me that helps most with understanding RJW. So you have the customers, which would be like a CPG company. I mean, you think Red for Kellogg maybe, and then that goes into this warehouse consolidation center that RJW has in Chicago. And then, you can have those trucks mixed. And so there you're taking advantage of the greater efficiency of filling up the full truck and goes to retailer DC, and then RJW manages those truckloads. So you eliminate the on stock, the out of stock, not having it in full, et cetera, fees. Anything you would add to that as a sort of a quick summary?
Yeah, we're representing over 550 different suppliers, CPG companies, food, beverage, almost every category within the retail store, and taking those LTLs, combining them into truckload quantities, and then delivering them straight to the RDCs, which then fulfill those stores afterwards. So we're definitely in the warehouse space and the trucking space and analytical space to look at how a supplier can get better in stocks and be a better supplier to get extensions within their item set or mod sets on an annual basis.
Got it. And on the topic of warehousing space, I wanted to ask you, we hear a lot about that. Sort of from your perspective, what's the current state of the warehousing space?
It's interesting. We've got 5.2 million square feet this year. We have added a total of 3 buildings, 1.8 million square feet. And I've seen kind of the constraints to the warehouse space by limited amount of warehouse space that was needed as we came through the pandemic. The demand for more space for the demand that was out there was high. So as we've progressed through those 3 different warehouses that we leased this year, it was becoming more and more difficult to find that 500,000 square foot space or more. It began to to shrink, and vacancies, there were fewer and fewer. And most recently, if you look at the current state of warehouse space, while a lot of companies have slowed down going out due to a potential or a recession that we're living in and potentially going to get worse, inventory levels have spiked probably to the peak right now, where inventories are at a high, all-time high, just because it's slowed down on the back end, and people were preparing for the demand early in the year to duplicate 2021, which isn't the case this year.
Yeah, so in terms of that, I mean, warehouse is very full right now. I mean, what constraints do you see on the market in terms of adding new capacity there? Is it not having the space? Is it not wanting to sort of build the church for Easter Sunday? What do you see there?
Yeah, I think there are a lot of projects right now across the country with buildings going up, with investment and buying dirt and raw materials will return. Those constructions of the delivery of new warehouses that are going to come to the market, along with the construction of what's available today, in the short term, we see that there's not a lot of space, depending on which market you're sitting in, to go out and find space to hold those inventory levels. So as you look at too much inventory, a lot of that inventory that was ordered 14 to 20 weeks ago. So they're ordering that based on lead time to get the raw materials and bring it into the facilities, and then a slowdown in customer demand kind of constrained what's available out there right now. But I think we're sitting at the peak of inventory holds right now, looking at international containers being imported slowing down, and then goods for replenishment slowing down, depending on which category you're selling into to those retailers.
Yeah, that seems to be the issue, is they have to order these things 15 or 20 weeks ahead of time. Sometimes the consumer spending can go down sharply, and then you're left with too much inventory, maybe in responding to not having enough inventory earlier. So you were doubling down on how much you were ordering. How do you see, I mean, I can combine maybe a couple different sectors into one here. How do you see retailers responding to this? How do you see the companies that are maybe CPG companies or other just consumer goods companies responding to this? And then what do you think we're going to see heading into the peak holiday season? I mean, you think it would be just kind of a bonanza of cutting prices, but how do you think about that?
Yeah, well, we've seen it already where, patio furnitures. I was walking through Walmart at the end of the season and just slashed patio furniture that we're selling early in the season at $800-900 down to $200, because retailers like Target and others have a backlog where they've got to get space on the shelves with items that aren't moving right now. So they're in a predicament where they've got containers, they got warehouse full of goods that they want to bring into the seasonal set, whether it be Halloween or Thanksgiving into Christmas. But in order to do that, they've got to get these no moving items off their shelf. So the only way that retailers can deal with that congestion at the store level, at the shelf level, is to discount the heck out of it. And that's what we're seeing right now. And I think we're going to continue to see more and more of that through the peak, where they've ordered too much, because in some cases retailers are planning for seasonal in the spring, if not sooner. And looking at last year's high demand, where retailers didn't have enough inventory, and if they had enough inventory, they'd be able to sell out of it quickly. You look at the first quarter after peak last year, everybody talked about just in case inventory, because if you get it, you're going to sell it. And everybody jumped the gun to get that just in case inventory. It pushed up inventory levels, demand stopped, and now we're in the predicament we're at today. So how retailers are responding to it is heavy discounts. And I think as we get past Black Friday and a week earnings, we're gonna start seeing major major discounts at the retailer levels, especially with inflation that's happening. So you might see some big discounts the closer we get to the holiday, because they want to get rid of that inventory as well. As a supplier, suppliers I look at, and we see it in our business, they're scrambling for extra space, for the raw materials that they're not needed right now due to them having too many finished good inventory levels. So they've got places to put that. They're scrambling. They're looking at their item sets, as you mentioned before, getting rid of the low performing items that aren't moving, and then focusing on the ones that are, and putting all of their effort and concentration in those items that are really moving. So reduction in SKU counts, and getting rid of those, whether they're donating them, whether they're destroying them. If you've got shelf life and you're in the CPG end, disposal we're seeing more and more of, and donations where they can donate. That's my take on it for peak season and how suppliers and retailers are kind of dealing with it.
Yeah, that's really interesting. I mean, there's a lot of levers they need to pull, and it seems like, well, the rising interest rate environment just makes carrying lots of inventory more expensive, and so many items just have shelf life, even if you don't think it's a shelf life, because it's only sells during certain seasons, and kind of have the opposite problem that we had. Like last year at this time, the Halloween costumes didn't come until November or December. So it's amazing the difference a year makes in the world of freight transportation. Can you talk a little bit about just the fluctuation in the rates to lease warehousing space, and how long it takes for the construction of new warehousing space to come online? Do you have any thoughts on that?
Yeah, I mean, we're looking in other markets right now, and I have a lot of conversations with a lot of the big players when it comes to building and delivering warehouse space. From what we're seeing, again, I think that we're sitting at the peak when it comes to leases. We've seen a slowdown in demand for the limited space that's ready. But there are tens of millions of square feet of warehouse in Chicago, for instance, alone, that are going to be delivered in the first and second quarter of next year. Wow. That inventory levels that we're seeing that are peaking, I believe, because they've stopped ordering. You've seen it, imports from Asia that's coming in, and you're starting to see the peak of all the raw materials, the inventory, finished goods. Those are at the peak, and they're going to begin to fall. So within the next 6 to 10 months, I expect leases to not be renewed. Delivery of, I think, 30 million square feet in Chicago alone is one example. And we're going to start to see demand for leasing space settle. I mean, you've seen it with Amazon giving back the buildings and seeing what they're seeing. Most recently, I believe XPO announced down in Dallas they were giving back 1.2 million square feet in partnership with Pepsi to give that space back. I think we're going to continue to see that. We're going to continue to see trucking companies go out of business, I think, because of the interesting information you talked about for demand of trucks and that market falling, and will fall into a recession. So there's going to be opportunities with every recession, but positioning yourself to be able to go to lease, renew lease, and really getting it back to the leasor's advantage rather than the landlord's advantage, I think is coming here pretty soon. It was short-lived through the pandemic, but that's my guess, and it's obviously a guess from the information that I have.
I think that's probably going to be right. I mean, we have a sonar chart on that. If the production team could put that up this is Logistics Managers Index warehousing prices, and that chart makes you think they did peak already, earlier this year. So I'm not sure exactly how this is calculated, but going from 90 was sort of all-time high, 5-year chart. Now it's sort of back down to where it was pre-pandemic levels. So you sort of heard it here. If you're in the middle of building a warehouse, you're probably too late, and maybe try to not do that, because it just seems like there's going to be more warehousing space that comes online right in time for the inventories to be brought down when they're takes time for the warehouses to be built, and it takes time for inventories to be brought down, and those things could coincide. So that's really all the time we have. But I want to thank you, Kevin Williamson, for joining me on the show. Where can folks reach out to you?
You guys can catch us on rjwgroup.com. A lot more information on what we do and contact information as well.
Fantastic. Go do that, and hope everyone has a great day.